Hello and welcome back to the Zoo Tour. This is our educational segment where Robert and I teach you something about trading. I'm Christopher Smith,
And I'm Robert Coburn.
and today we're going to be talking about indexes and passive investing. Robert, this is kind of the way that you like to invest, isn't it?
Yes, the slow and methodical way of investing, which basically means that there's not a lot of thought put into it because you just basically throw your money at an index. In most cases, it's an ETF or a mutual fund, and you just kind of forget about it for a decade or two. Uh, Not really a decade or two, but I mean, in some cases, yeah, you want to forget it for a decade or two. But in some cases, you just want to, put it in and put like thousands of your dollars in an ETF or a mutual fund and just let it sit for, you know, X amount of years, X amount of months, and then the amount of interest, compounded interest especially, will basically make your money work for you and without you having to manage your portfolio, manage individual stocks, moving your money around all the time. Uh, Index investing is basically just a passive strategy to you capture the return of like the broader market or a specific market. So there are typically two types of investing. There are ETFs, which are exchange traded funds, or mutual funds. ETFs, they're they are most commonly like a collection of stocks, but can also include like commodities and bonds, and they're traded like individual stocks on the stock market. But they typically have like a small management fee, whereas mutual funds that are similar to ETFs, they usually require a higher minimum investment. Usually, it's like $1,000 or more. And they're also actively managed, which basically means that their management fees are going to be a lot higher. They're not traded like normal ETFs or like normal stock where on the market, but they're purchased directly from the fund itself, and they're usually priced out at the end of each trading day. So they don't really change in value during the day, and you can't really buy them like during the like intraday trading, but they're usually bought at the end of the day.
Yeah, and that annoys me. I much prefer to trade ETFs because ETFs give me the opportunity. If I see what looks like a peak, if I see a price hit a critical level in the middle of the day, I often like to get out at that critical level because it's going to bounce back down. So I think that ETFs give you a lot more flexibility in terms of where you get in, where you get out, how fast that happens. And definitely, you're right that the pricing can be better. Uh, I think passive management is usually better than active management. Not all mutual funds are actively managed, but there's a lot to like about ETFs.
Yeah, especially the ones that are managed by the uh, major trading platforms themselves, like Vanguard. And I mean, Vanguard and Fidelity, they all have their own sets of ETFs that they manage themselves, and you can usually find them through those specific trading platforms. Usually, they'll have like their own that you have to go through them to get. But other trading platforms, sometimes they will allow you to buy theirs. Like I know Vanguard, you can buy it on Fidelity. Uh, but they can help you capture like certain specific markets within the stock exchange. So you can get like a tech ETF, or you can also get agriculture ETFs or bank ETFs. So basically, instead of catching the whole market, you can get specific markets. So if you believe that banks overall are going to make more money over the longer term, obviously you'd want to look at like a bank ETF. But if you're looking for like tech stocks, then you look for like a tech ETF that basically captures just the tech sector.
Yeah, I love to play the sector ETFs, and we'll have to do an episode on sector ETFs at some point because I think that's a really cool, versatile way to play the market. But today we're just going to talk about the major indexes, the broad funds that cover a lot of different sectors and a lot of different parts of the market.
Yeah, and first we want to go into why you want to invest in the indexes in terms of their safety, their benefits. Uh, so what makes them safe, Chris?
Well, your risk is a lot lower because the whole market is always going to come back up. Over the last, 100 years or whatever, the market has always come back up and hit new highs. Whereas individual companies, if I put my money into a single company like PG&E, and then PG&E announces that they're going bankrupt, PG&E might not ever come back up to where it was when I bought it. And so I could lose a lot of money. But with the broad funds, if you just hang on to them long enough, you're always going to make your money back.
You also benefit from the wisdom of crowds. So individual investors who try to pick stocks almost always underperform the average of the market as a whole. So no matter how smart you are, there are always people out there with better information than you. And the share of the market information that one person can know is pretty small. And portfolio managers dedicate their lives to this, where you just might be investing on the side and can't dedicate as much time to research.
Yeah, and they're also less work, which has a lot to recommend it. You can put your money in and walk away, don't think about it, enjoy those tax benefits of long-term investing, and you can work a day job and you don't ever have to spend any time on your stock portfolio. So really, this is probably the smartest thing that you can do with your money. And if you invest with a financial advisor, this is pretty much what they're going to charge you a fee to do for you, and you can do it on your own. Just drop your money into an index fund, walk away, don't look at it, and you're good.
Yeah, it almost works like your 401k. If your 401k has ETFs, but I mean most 401ks are made up of ETFs or mutual funds.
Yeah, that's right. This is what your 401k is probably going to consist of, is a broad index fund. Hey, let's talk about the major indexes, Robert. Starting with the S&P 500.
Yeah, the S&P 500. It's basically an index that comprises the 500 largest companies by market cap. So approximately 80% of the value of the stock market. So most investment companies have at least one fund that follows the S&P 500. A popular one is the SPDR S&P 500 ETF, also known as SPY, a leveraged fund that tries to give you three times the gains or losses of the index is the ProShares ETF, Ultra Pro ETF, also known as UPRO. The rationale of buying the S&P 500 is that the biggest companies have the advantage of scale, so they're usually safer to grow faster on average than small companies. A downside is that large company stocks are relatively expensive, and it's possible that there's a bit of a bubble of people buying the S&P 500.
Yeah, I'm gonna bring up the S&P 500 ETF that you mentioned there, Robert. This SPY fund, and I'm gonna pull up the full featured chart. And TradingView has this cool feature where if you put you've got your ticker here, if you put a slash and then put another ticker behind it, it will compare the two tickers and show you their relative movement. So it's going to show you how much better has the first one that you put in been than the second one that you put in. So let's just compare the S&P 500 to AMD. So the S&P 500 has actually lost compared to AMD over the last year. So if you had just owned AMD, you would have beat the market in terms of compared to the S&P 500. If you had owned, let's say, a small cap stock, actually, let's pull up Ameritrade. This is a bank stock. So here, if you own the S&P 500, you would have beat the market. And you can see this huge jump right here. This is where Ameritrade lost a lot of value. So the S&P 500 looks really good relative to Ameritrade. So this is a kind of a fun way to compare some of these indices. So the next index that we're going to talk about is the Dow Jones Industrial Average. This is a really famous index. It's probably the number one index used by journalists as a measure of the entire stock market. But I actually think that that's kind of a mistake because this only includes 30 companies. One nice thing about the Dow is that it's pretty diversified in terms of sectors. It's got sort of like the biggest company in each sector. So it could be fairly robust against a downturn in one particular sector. But on the other hand, because there are so few companies in the index, it can get hit pretty hard if just one or two of those companies has a bad year. So the S&P 500, because it has more companies, it's less sensitive to bad news for one particular company. If you want to invest in the Dow, you can use the SPDR Dow Jones ETF, which is DIA. So let me pull that up. There's also a leveraged, ProShares has a leveraged fund called UDOW, the Ultra Dow Leveraged Fund, which tries to give 3 times the Dow's gains or losses. But let's just look at the S&P 500 versus the Dow. So let's see, since August 2018, the S&P 500 has slightly underperformed the Dow, but within the last year, if you had bought in January 2019, the S&P 500 has slightly outperformed the Dow this year. So let's just pull up a much longer time frame here. Overall, the S&P 500 has probably outperformed the Dow, but since 2015, the Dow has done better. So you can kind of maybe time some of these market cycles. If you see that the S&P 500, for instance, is looking really weak against the Dow, maybe that's time to get out of the Dow and get into the S&P. If you see that the Dow is relatively cheap compared to the S&P, that might be time to get into the Dow. So this is kind of a fun way to compare those indexes and see how they're doing relative to each other.
That's really
Why don't you talk about the NASDAQ there, Robert?
So the NASDAQ, this is one of my favorite indexes to look at because, me being tech oriented. So this is a pretty broad index that's weighted by market cap. So it includes small and middle sized companies, but it emphasizes the big companies. So the NASDAQ is pretty heavily weighted toward technology and biotechnology, but it also includes some stocks from other sectors like finance, industrials, insurance, and transportation. The advantage of the NASDAQ is that technology is a hot sector, so the NASDAQ tends to outpace indexes that have more exposure to dying industries like oil and gas. To invest in the NASDAQ, you can use the Invesco NASDAQ ETF. QQQ is the trade symbol. Or the leverage ProShares Ultra Pro NASDAQ ETF TQQQ.
Yeah, so let's pull up the NASDAQ versus the S&P. So you can see here how much the NASDAQ has outpaced the S&P over the last 10 years or so. I mean, it's really soared compared to the S&P 500. So I think that, tech is the future, artificial intelligence, especially big data. The NASDAQ is going to continue to outperform compared to the S&P 500, in my opinion. This is, I think, the index of the future. All right, the Russell 3000 is another index. This one is an index that tries to track almost the entire stock market. It's a whole market index. It includes the 3,000 largest U.S. stocks, covering 98% of the stock market. It's cap weighted, which means that it emphasizes the largest stocks. And so this is a great way to have an extremely diverse portfolio while still benefiting from the advantages of large cap stocks because it's cap weighted. To invest in the Russell 3000, you can use the iShares Russell 3000 ETF, IWV, and there's no leveraged version of this fund. So let's just look at the Russell 3000 versus the S&P 500. You can see it has stayed, fairly in line actually with the S&P 500. So it's pretty. The S&P 500 appears to be pretty representative of the whole market. But S&P 500 does slightly outpace the Russell 3000 over, long period of time, but only slightly.
Yeah, and the Russell 2000, if you're following along, tracks the smallest 2,000 stocks by market cap as opposed to the Russell 3000. But it captures the smallest 2,000 stocks that are within that Russell 3000. So the Russell 2000 is a good diversified way to invest in small cap stocks that a lot of other investors overlook. Usually small caps underperform the market, but once in a while they go on a major run where they outperform the market as a whole. To invest in the Russell 2000, you can use the iShares Russell 2000 ETF, IWM, or the Leverage ProShares Ultra Pro Russell 2000 ETF, or URTY, which seeks to capture 3 times the moves of the Russell 2000. So this is probably something that you would be more interested in because, in other words, you'd find where the trend is, where the bottom is, where the rallies are going to start, and then basically get out as soon as you feel that the market is capped out.
Yeah, that's exactly right. Let me go to the weekly here so that we can see a longer time frame. So actually, I mean, there was a period here in the early 2000s when the small caps were doing really well. They outpaced the whole market. But in the last 10 years or so, the small caps have underperformed the S&P. But, I'm looking here, I see that, we're at a point now where small caps are very cheap compared to the large caps. We're at a low here compared to the S&P 500. So I might consider buying here in order to get, the rally up to about here. I might look to invest in small caps because I see that they're inexpensive right now. So but I would only hold it for a relatively short period of time. I'd hold it for a month or two until it comes back up against the S&P 500, and then I would get out again. So this is a good instrument to maybe swing some of those short-term periods of outperformance by small caps. But over the long term, you're probably better off investing in larger cap stocks. All right, one more index worth mentioning, Robert, is the dollar index. The ticker is DXY. So I'm just going to pull this up here so that you can see. Usually currencies are traded in pairs. So you trade dollar for euros or dollars for yen or dollars for bolivars, right? So for instance, I would use the ticker USD GBP if I wanted to look at the dollar versus the British pound. So this tells me the dollar has been, stronger than the British pound over the last 10 years or so. But the thing about looking at currencies in pairs like this is that I don't know whether this is moving up because the dollar is strong or whether this is moving up because the pound is weak. So in order to isolate just the dollar, this index right here, the dollar index, is taking an average of all of those different currency pairs. So it's looking at the US dollar versus all of those different currency pairs and taking an average of it so that I can just isolate the dollar and see whether the dollar is strong. You can see right now the dollar has been in this nice uptrend, but it appears to be breaking out downward below the trend line that it's been forming. So there's potentially, we could see the dollar collapse below this trend line next week. And that would tell me that gold is probably going to do well. Cryptocurrencies are probably going to do well because when the dollar is weak, those other currencies and commodities tend to be strong.
Heard that everyone rally on cryptocurrency.
Yeah, I don't love crypto, but there are lots of folks who like to do crypto. I wonder if there's a cryptocurrency index, Robert. Do you think there is? Let me just type cryptocurrency. Hey, look at that. There's an XAI cryptocurrency index. It looks like it's fairly new, and I'm not sure what these huge... Oh, there's some huge volatility in this. Not sure exactly what's going on there, but if you're interested in cryptocurrency, maybe there's something here, but personally not my thing. Let's see, iMining blockchain. Okay, this one looks better, but still, you can see hasn't performed great over time. All right, Robert. Well, that's our episode for this week. Anything to add before we sign off here?
No, just make sure you don't forget to like, share, and subscribe. Leave a comment below. Let us know if you learned anything or if there's anything you want us to go over. Make sure to follow us on Twitter, like us on Facebook, and also if you aren't already signed up on Webull, We do have our referral link in the description below that helps us with the purchasing equipment and also supporting the podcast.
Hey, thank you guys so much for supporting us. Thank you so much for listening. We are interested in hearing from you what you want to learn about. So leave us a comment to let us know what you want to learn about. And we'll see you at the zoo next week.